Hey everyone, thanks for joining me for this one. In today's video, I'm going to talk about the 5 stocks that I've been buying up throughout this week now that this week is said and done. Overall, this week was one to forget for me. My stock portfolio is down this week. In the Canadian side, I'm down about $1,600. When I go over to the US side this week, down over 600 US dollars. So collectively down $2,000 to $3,000 across my account. But gonna go into what stocks I was averaging into and buying up in my portfolio. Some of them I was averaging down on, some of them we're building out new positions on. So gonna go through that here. If you like this kind of content, be sure to give me a thumbs up for the YouTube algorithm as I scroll to the first company here. It really does help out a lot. The first stock that I was buying up this week is actually an ETF. It is ticker XIC, and this is essentially a TSX market ETF where this ETF essentially has exposure to every company that's on the TSX. Looking at the performance, it's up about 3% in the last year, in line with the market. What I really like about this ETF is it gives me very broad diversification within the Canadian economy, while still paying me a pretty nice dividend yield, about 3.2% paid out quarterly as well. The average PE multiple of the Canadian market is, I guess, around 15 times given the PE ratio they have here. And one of the other things I like about this ETF that is a bit better than lots of the other ETFs I hold is the management fee is only 5 basis points, give or take. So under 0.1%, I really don't have to worry about that cannibalizing lots of my returns or lots of my capital over the long term. So I really like that element of it. And this is one where I bought 20 shares, give or take, in the last week. It's a new position for me just to broaden and diversify out my Canadian holdings. But it's one that I can see myself building into a significantly larger position, like a $5,000, $10,000 position in the weeks and months ahead. So this one is a pretty boring one to buy. Not too much of a hot take, just getting more diversification within Canada instead of just adding to any specific Canadian stocks in a great amount. I thought this was one that, hey, I can build out a pretty good size position here and have my portfolio one that I can sleep a bit easier at night, knowing that if one sector or one stock fell, it wouldn't really have broad implications for this position at least. Looking at this ETF over the long term here, I moved it over here. You can see that it's really gone up nicely over the last 25 years. And in addition to the gain you're seeing of 155% since about 2001, so in the last 22 years, so about compounded return of about 6%, give or take, you've also gotten the dividend yield of about 3% a year. So overall, this isn't a stock that I'm going to get rich off of, not a stock that's going to go up 50% in a year or anything like that likely, but it's also one that I hope doesn't go down 50% of the year, go bankrupt or anything like that, given the fact I'm holding every Canadian stock with this holding here. The second stock I was buying up more of this week was Jameson Wellness. So Jameson Wellness is a stock I've talked about before. I actually previously owned the stock a couple years ago, I think. Bought it around $35 during the pandemic, so I'm trying to find where it was, maybe somewhere around here. And then I ended up getting out of it around $41, give or take, so probably around here. So did pretty well, made about 20%, thought the valuation was getting a bit lofty, and I actually took the proceeds from Jameson Wellness at the time and started my position in Restaurant Brands International, which has ended up very well for me, at least so far. But since then, Jameson has actually gone down to really attractive levels, in my opinion. The company's currently trading at about a 16 times current year price to earnings ratio. The dividend, which they've increased every year, is now getting almost at 3% here. And the overall company is trading at just over $1 billion. This company produces $80 to $90 million of free cash flow. They've been growing at a really nice rate over the last 10, 20 years. And even though some of that may have got pulled forward with COVID, I think the theme of wellness and lots of the products and markets they serve have a lot of opportunity to go up. So it's trading at a market multiple for a company that I think will prove to be a growth stock longer term. So I've been nibbling into it slowly but surely, up to 50 shares now, which is not too bad of a position size for just kind of buying into it over the last 1-2 weeks. Currently down about 1%, so essentially flat. But I'll continue to buy into this company here as long as it stays around that mid-20 $25, $24, $26, $27 range. My next goal on this one with time is just to get up to 100 shares and then go from there and see how the company's performing, how their next earnings report does as well. Okay, going into the US side, since those were the two only Canadian companies I was really buying throughout the week here. On the US side, there were three other companies that I was buying into. The first one was S&P Global. So S&P Global is a really fresh position. I've just been owning it for a couple weeks now, and I doubled my position this week. I think I added about 3 shares to get to 5 shares total, so I have about $2,000 in this one. Looking at the metrics, they pay about a 1% dividend. Their forward PE is closer to a 28, 29. Not sure why it says trailing 54, maybe some accounting components to that, or maybe a tax bill, a one-time expense, or a write-off in the base or something. But forward, I'm paying about 28, 29 times. $125 billion company, so this is a big business. Looking at the company long-term here, in the last 5 years, up almost 90%. And then even longer term than that here, as I go max, you can really see the exponential growth that's occurred in this stock, up over 1,000% since the financial crisis, even since 2010, give or take, up about 1,000%. So has performed really well. It's lots of elements of this company that I really like. The first one is their indices business. So anytime anyone puts more money or assets under management into an S&P fund or a Dow Jones fund, SPGI actually owns those underlying indices and the decisions that go into what stocks are in those indices. So they get a couple basis points for every dollar of capital that people have in those indices. And the S&P 500 and lots of these other indices are go-to investments for lots of investors, whether big investors, small investors, hands-on, hands-off investors. So all of those dollars that are going into those accounts, they have, while a very small amount, pennies and pennies coming back to SPGI, and that's a very profitable business. The other business that I really like that they operate in is their credit ratings business. As people continue to raise capital to go public, raise capital via bonds or debentures or whatever they're raising money for and selling securities for on the public market, all of these big firms will not touch any security unless it has a credit rating and a risk associated with it that they can kind of assess and stand behind to their bosses, to their investors, and say, hey, I know this went belly up, but this was what the credit rating was. This was the strategy. And it kind of serves as that protecting element of buying $1 million, $10 million of bonds in a company, knowing that S&P Global or Moody's, who's the other company in the duopoly, have kind of given it a stamp of approval and a certain rating that you're willing to sign up for whatever risk they put on it, whatever the yield that security is providing in terms of the risk reward of that dynamic. So I really like that business because it's really defensible. No matter what's going on in the economy, people are still going to be trying to raise money and investing in different things. Sometimes if the economy goes down, more people may need to release bonds and raise more capital and debt in order to get through tough times. S&P Global and Moody's will continue to rate their bonds. Also a lot of pricing power in that segment. So really like lots of components of their business, very different, unconventional type of company. I own lots of real estate, lots of banks, lots of consumer products companies, etc., royalty funds on restaurants. So this just fits in nicely as a company that's relatively global in nature, has operations in Europe. The US is obviously a huge trip for them in other areas of the world. But in addition to geographically, they also provide a really unique service that no one else in my portfolio really provides. So I like that diversification element, and I like how high their moat is on these kinds of businesses that they operate in. So looking to build this into a bigger position, I think my only concern or issue with making this an overly big position is it is still an expensive company. I'm paying for quality, I'm paying for the high moat, but I am still paying a forward PE in the high 20s when I can get really good stocks for 20 times, 21 times Even Jameson Wellness, we just went over, was 16 times. So their profits I'm getting for half the price as S&P Global. So they really have to be on a really fast growth trajectory. Lots of that moat may be priced in already. So I'm going to continue to evaluate, continue to look at what price they're trading at and their earnings reports as they come out, as always. But this is one that I'd love to have a bigger position in as well. Going on to the fourth stock that I was buying this week, and it is actually another ETF. It is the Vanguard Total International Stock ETF. So this company here, over the last 1 year, you can see up about 9%. This is essentially a global stock market ETF minus the United States. So I have lots of positions and stocks that cover the US and Canada. So this is just one that I'm looking to build out to get more diversification in Latin America, across Europe, in China, in Australia, in Africa, and India. This company holds country ETFs for pretty much every big or relevant country in the world, and it takes out the US, so then the weighting's not all screwed up and I own 1/3 of the position in North America, which isn't the objective here. So really like this just from a diversification play. Another one similar to XIC that I started off on, can really sleep at night well knowing that one stock or one sector will not impact this ETF to any great extent. One country as well, for the most part, will not impact this to a great extent either. And I also get a nice 3% dividend yield. So I'm getting diversification from a geographical standpoint here to a great extent. And I'm also getting paid 3% for it as well. Slightly lower price to earnings ratio as the Canadian market, 14 times instead of 15 times. But ultimately, this is just a bit of a hedge and a security blanket, given that the vast majority of my net worth is in stocks and single equities. I like the idea of having a bigger position built out in these broader market ETFs across Canada with XIC and the rest of the world with VXUS. So this company here, given the nature of needing to access lots of smaller countries and different markets, different currencies, I believe the management fee is closer to 0.4%. So I obviously like the 0.04% or 0.05% on XIC a bit better, but I understand why I have to pay a bit of a premium to get access to all of these countries, all these currencies, and all of these different areas of the world. So I'm willing to make that investment, pay that 4.4% a year in order to get this really rare and really cool access to broader markets. And going into the last stock that I bought this week, it is Coca-Cola. So Coca-Cola, this is one, unlike the first four that are pretty new positions for me, this is one that's a pretty developed position here. Have 166 shares now, or about 10,000 US dollars. I think I bought about 5 to 10 shares throughout the week here as the stock's been downtrending. You can see here in the last week, we're down about 3%. I thought it would be a good opportunity to average down. Currently, I'm down 3% all time on this portfolio, or this stock, rather. Looking at the dividend yield, I'm getting over a 3% starting yield, 24 times price to earnings, $250 billion market cap. And I just have a lot of faith in Coca-Cola's pricing power over time, their business lines, the fact that in an economy that weakens a bit, will people still be enjoying, beverages and sodas and waters and going out to concert venues and stuff like that? I think the answer will be yes. So I've seen the company stall here over the last year or two. Thought it was a good opportunity to buy in, especially when you look at this company long term. They've really done a really good job of moving up, pretty lockstep, trading at a pretty hefty valuation usually. So since the company's kind of stagnated here a bit, I don't think anything will change in terms of their long-term trajectory of creating shareholder value or increasing their dividend every year. I think they've done it for about 60 straight years. So I said, hey, starting yield over 3%, think this is a good time to get in. Right now, looking to get this position closer to 180 shares plus. So almost there, and always willing to invest more in really high quality companies if the value of the shares continue to decline for no fundamental reason. So that's kind of the one that I bought into this week based off of a bit of a dip in the price. Even as I look in the last month here, down closer to 5%. We're at $61 at the beginning of the month, or about a month ago. So don't mind adding it here under 60 bucks a share. We'll continue to average down. My current average price is just over 60 bucks a share, but comfortable holding this one for the long run and building that compounded dividend increase, which will hopefully increase every year. So hope you guys enjoyed me going through these 5 stocks in my portfolio that I added to this month. Lots of new positions I'm building out, like XIC, VXUS on the ETF front. And then JWell, really a value play. I really like that company, Jameson, ticker JWell, for the price it's trading at. And SBGI, I just think it's such a high quality stock. So hopefully I can get better pricing on it, can make it a bigger part of my portfolio. And hopefully my overall portfolio can start to rebound here. My US portfolio is up about 17% in the last year, but the Canadian side has really lagged behind. Bank stocks going down, REITs going down, some of my utilities going down behind interest rates staying higher for longer. I'm not worried long term. It's actually provided a nice opportunity for me to build a bulkier position in some of these stocks, but we'll see if it turns around from here. Hope you guys have a great weekend, and I'll see you guys in the next one.